Let's be honest, in today's economy, a standard savings account just isn't cutting it for most of us. So, we're going to explore an alternative that's been making a lot of noise: peer-to-peer lending. It promises much higher returns, but the big question is, are those returns really worth the risk? Let's dive in and find out.
You've probably felt this, right? You look at your savings account, and even with so-called high-yield rates, it just feels like your money is treading water. Inflation is still hanging around, and that cash you've worked so hard for, well, it might actually be losing its punch.
And here's why people are looking elsewhere. I mean, look at this. A really good high-yield savings account today might get you around 4%. Not bad. But then you see peer-to-peer platforms dangling potential net returns, and that's after fees and expected defaults, of 7 to 10%. That difference? Well, that's a game changer, and it's exactly why we're talking about this.
Okay, so let's properly unpack this whole savings account dilemma. In a world where prices just seem to keep creeping up, the hunt for a return that actually grows your money's real-world value, it's more important than ever.
This right here, this is the frustration. Think of inflation like a slow, constant headwind. It's always pushing back, eroding what your savings can actually buy. So even if the number in your account is going up, your spending power might actually be shrinking. And that feeling is what's pushing people to look for other options. So one of the biggest alternatives that pops up is peer-to-peer lending. The promise is simple: cut out the big banks, and you, the investor, get to keep more of the profits. But how does it actually work?
You know, the concept is actually pretty simple. Instead of a bank playing middleman, these online platforms are basically just matchmaking services for money. They connect people like you, who have money to invest, directly with people or businesses who need a loan. The bank is just out of the picture.
This is truly the best way to think about it. For a small slice of the financial world, you become the bank. You're the one providing the loan, and in return, you get to earn the interest that would normally go into the pocket of a giant financial institution.
And make no mistake, this is not some small, niche corner of the internet. The global P2P lending market is on track to be worth over $1.3 trillion by 2034. It's a serious, fast-growing force in the world of finance.
But, and this is a huge but, whenever you hear the words higher returns, your brain should immediately ask, okay, what's the catch? So let's get real and take a balanced look at the trade-off here: the awesome potential versus the very real dangers.
It really is all about this balance. On one side of the scale, you've got the good stuff, those high yields, the dream of passive income, and a new way to diversify your portfolio. But on the other side, you've got some heavy risks: borrowers who can't pay you back, the fact that your money is tied up, and even the platform itself going bust. You just can't get one without the other.
Out of all of these, borrower default is the big one. That's just a fancy way of saying someone can't pay back the money they borrowed from you. And historically, those default rates can be anywhere from 5 to 17%, depending on how risky the loan is. And you got to remember, unlike a savings account, your money is locked in. You can't just pull it out tomorrow if you need it.
Okay, so that's all the theory, but what if you wanted to actually try this? Let's walk through a simple game plan for how you could invest your very first $1,000.
First things first, you've got to pick a platform, and they're not all the same. A platform like Prosper, for instance, has awesome tools to just set it and forget it. Upstart uses AI to find good borrowers who might not have a long credit history. And then you've got places like Funding Circle that only do business loans. It's all about finding the one that fits your style.
So here's a simple but really effective blueprint. The number one most important rule is diversification. Don't put your $1,000 into one loan. Split it up. Put $25 into 40 different loans. That way, if one person defaults, it's just a small bump, not a catastrophe. Then you use their tools to automate it and, this is key, reinvest your earnings to let that sweet, sweet compounding do its magic. And here's what that smart allocation looks like. You'd put the bulk of your money, maybe 60%, into the safer A or B grade loans. Think of these as your reliable base. Then you can take the other 40% and put it into some higher risk C or D grade loans. They have a bigger chance of defaulting, sure, but they also offer much higher interest rates to make it worth the risk. All right, you've got your strategy down, but what can you actually expect to make? You see a lot of hype online about making a fortune with P2P, so let's cut through all that noise and talk about what's actually realistic.
This is the kind of claim you'll see on social media or in forums. And it sounds incredible, doesn't it? A steady $200 a month from just a $5,000 investment. But is that even remotely possible?
Well, the math says no way.
To make $2,400 a year from $5,000, you would need a 48% annual return. Let me just say that again, 48%. That is just not going to happen in a normal P2P lending portfolio. It's completely unrealistic.
Now here's the grounded, achievable number. With that same $5,000, earning a really solid, very respectable 8% net return, you're looking at about $33 a month. Now that's not going to pay your rent, but it's real, it's passive, and it's beating the heck out of your savings account.
So is that $200 a month goal possible? Yeah, absolutely. But as you can see, you need a pretty significant amount of capital to generate that kind of income stream. This isn't a get-rich-quick scheme. It's a tool for slow and steady wealth building.
It really all comes down to this idea. There are tons of success stories out there, for sure. But the people who succeed are the ones who balance their excitement with a healthy, clear-eyed awareness of the risks. That's the secret sauce.
And that brings us right back to the only question that really matters. Now that you've seen the potential for higher returns, but you also understand the real risks of default and having your money tied up, is this the right move for your money and your goals? Only you can decide if the reward is worth the risk you're willing to take.